Hey everyone, it is Wednesday. This is topic number 2, and this is a big one, right? Matt, the mortgage guy. So I am hearing, I am feeling, I am seeing with my students, investors, and followers on this channel that getting a mortgage, right? Mortgage availability, mortgage credit availability is a little bit harder today than it was maybe exiting 2019. I've talked about on my daily financial news, many banks like Chase really ratcheted down in, I'll call it April. But let's ask Matt. He sees the numbers. He's got some data. So Matt, is it harder to get a loan today than it was maybe earlier in the year?
It is, and it's been a trend that's been happening over we'll call it the last 18 months. And I've got, graphs that kind of back up that theory. It's unpopular, I think, in the lending world for a lender to say things have gotten harder, because anybody who's in a position of trying to bring in future business wants to say the opposite. Oh yeah, I can get a loan done for anybody's. If you've got a 500 credit score or better, we've got options for you. Come on down. And I prefer to just shoot straight with people.
Right.
And it better serves when I say, if you're self-employed, it's harder. Even if you've got a W-2 job and you're got a 750 credit score, it's gotten a little bit tighter, debt to income ratio wise. And so I want to show this graph that I kind of talked through on a presentation I did this morning, just to show, the numbers behind what is essentially it being a little bit harder to get a loan. The criteria is that box is getting smaller. Like you said, there's, and it's across the whole industry. If somebody says, well, not my bank or not my direct lender.
Yeah.
It's really everybody, because ultimately it's all going to Fannie and Freddie. And by all, I mean a majority. And so those folks make rules that are more constrictive. All of us have to play ball. All of us have to.
Yeah, because if they get tighter, then you can't undo an overlay, right? A bank would only add on top of. They're not going to.
Exactly.
Yeah.
Exactly. So the Chase stuff is like they're getting even tighter than the tightness that's being put on by the Fannies and Freddies of the world. But yeah, we punch stuff in, and in 2020, there's an automated system that says this debt to income ratio is allowed, this credit score is allowed. So there's no, it's pretty black and white. It's got to fit. So let me share this screen and I'll show you this. It's pretty cool to see, because it goes back.
Oh,
and so
look
that's
at that.
That's up on your screen. So this right here is 2006.
So let me tell you what I think this means. Again, I've never seen this chart before. So again, what I think this means is what I think this means is what is that? June of 06, my dog could have got a loan, because everybody could get a loan. That's what I think that peak means. And then
exactly.
it got really tight. So I don't know if you've heard me tell this story. The people that follow my channel heard. In 2010, so say June 10 on this chart, I walked into my bank, who had all my financials, who had done several loans with me. I had 7-figure net worth, 6-figure income, 800 credit score, and I was trying to buy an investment property that was on sale 50% off. And they told me no. I didn't know they could do that. Then I walked across the street to a bank I had no relationship with, and they told me, hell no. Right? They were rude about it, because again, they were telling me that at least in their eyes, I was evil. I was an investor and I was the problem. So that's what this chart tells me. And then what does it say? So 2019, June, right? Last summer, it was on a trend to get easier. But what's interesting is this started getting harder before COVID. Look at that.
Right.
How amazing is that?
And I'll speak to this 5-year, 6-year run right here, where, to contextualize it for folks, what does this mean when it goes from 100 to 200? This means that as, the market is super healthy and we've got year-over-year appreciation, lenders say, you know what? Instead of 600 min score, let's go to 580. Instead of 580, let's go to 560. Instead of capping our debt to income ratio at 45, let's go to 50, or let's go to 55. And so
let me ask you this question. Just if I look at going from 100 to 200, is it simple enough to say it's twice as easy to get a loan if it goes from 1 to 200? Is that kind of what I'm looking at here?
I mean, somewhat, but there's so many
variables.
points in here between credit score and debt to income that makes up this score that's hard to say. I mean, what is twice as easy to get a
Okay,
loan?
how about this? Is it twice as many people would qualify? Because again, you're playing with the variables, right? So your pool of approvable. I'm just trying to figure out. Really, what I'm trying to figure out is how do you go from 900 or 800 to 100? To me, that means the people that can get a yes answer has collapsed by
Right. You got 11% of the people that qualify here if it's, 1/9 of it or something. I get where you're going. And there's probably some correlation there,
Okay.
but I don't know if it's an exact correlation where, there was 44 million people that qualified here and now there's 88 million people that qualify here.
Okay.
Because, it's a function of a lot of different things, but we saw it and we felt it, in the mortgage industry. This doesn't mean that we're anywhere near no income, no assets, you can get a
Right.
loan done. All this meant was, hey, I've got a borrower who's got a 580 credit score and FHA is going to allow them to have a debt to income ratio, which means car payment, student loans, credit cards, plus their mortgage. That's 55, 57, 58% of their income, which, to be honest, as things got looser, folks who care about the long-term health of their clients' finances start to say, let's not go too far down this path.
That's a little dicey. Yeah.
Right. Because having stuff in place to protect people from themselves from this is good. Telling somebody you probably shouldn't buy 6 houses if you can't show that you've got ability to repay, that's a good thing. And so I would debate folks on this who get upset when it's like, this is BS. Why don't I qualify? Well, we want to put you in a position to succeed. And like you said in a prior video about the banks doing what's in their best interest, they don't want to foreclose. They don't want to go through that long, lengthy, expensive process. So they're trying to write mortgages that will perform. They want you to succeed.
Yeah. And I even want to go one step further. The reason I talk to you every Wednesday and we do these sessions is because you will tell somebody, you know what, you're skating too close to the edge, right? You personally don't want to put somebody in a mortgage that you think they have a chance of losing in 6 or 9 or 12 months. That's not a good feeling for you. You don't need the commission. You're just going to tell the borrower, hey, you know what, you may want to wait for a raise, or you may want to save more of an emergency fund. I've seen you have those conversations. Friends that have already reached out to you because you are part of this channel are telling me that. So first, good for you. So
thank you.
Yeah.
And so June of 19, as the mortgage lender, I'm taking somebody's information. That's credit score, their income, their debts, and we're plugging it into an automated system, the Fannie and Freddie systems that spit out approve eligible or ineligible, saying qualify or don't qualify, to simplify it. And where I said we got up to 58, 60% debt to income ratios, this coming down and this mortgage credit availability index going down means that these automated systems and the powers that be can kind of control these levers, say, no, let's go back down to 55. Let's go to 50. So they're tightening things up. Well, like you'll see on the, timeline, this is well before COVID. So this isn't a COVID induced, but as we get tighter and tighter, just because they've thought, let's not get too wild about who we're going to lend to and loans that won't perform. Then we see COVID. Then, like you saw and everybody else saw, banks, lenders across the nation start to tighten the reins because there's uncertainty. And with uncertainty becomes more risk. And with more risks, the banks say, let's shrink that bucket of people we want to lend to, because ultimately you're trying to get to a place where you've got credit available to a lot of folks, but a lot of folks that the loan's going to perform.
Yeah. The beauty about this chart for me, and why I'm going to want to see it from you maybe every month, Matt, is I'm trying to figure out, this will turn, right? The right now it's getting tighter based on this slight, whatever you call it.
Right.
I forget what that word is, but whatever, it's going down. The trend is going down. That will have a pivot. It will go up. My history with banks is they're late. And again, we'll see this time could be different. Maybe they're early, right? We're going to have a Fed decision after hours today. Maybe they come out and they do some kind of bond buying and they want to be ahead of the curve. Maybe, who knows?
Right.
But I'm gonna
Yes.
this will turn, and it's going to be interesting for me as someone who's been in the market forever, because the economy, I think, is going to be booming in 2021. So it's going to be interesting to see if mortgage availability gets easier. I think it will get easier. The question for me is when. Does
Right.
the
Right.
Fed force it, meaning early, or are they late and they're kind of late to the party? So it'll be curious to watch.
Yeah, I'm looking at on my computer at an article from the MBA that the number from November, because this goes through October, was up 0.7%. So it started to come back. And then, me feeling and seeing and having a pulse for lenders and how they're operating, I know that jumbo products have started to come back. Other products that got really, really strict over the last 6 to 9 months have started to come back. And I've got a great sample size because I've got 60 different lenders I can send business to, and all of them take jumbo off the table March, April, May. And then little by little, you've got a few who've got an appetite for it. And, they want 25% down. Another lender says, oh, I'll do 20%. Now I think we've even got jumbo lenders that will do 5 and 10% down. Wow. And those are certainly the minority. But, this is cool because it's across all different product types. And I think I've got a slide that kind of shows, this is a cool one because it's, I'll come back to that. But this one talks about like the average FICO score on purchase. And
oh, wow. VA 725. Okay.
Right. And to me, it kind of blows my mind that the average credit score is so high. And, probably a function of a lot of people with perfect credit who really have their finances dialed, went out and refinanced or
I think it's what I've been calling on my channel the K-shaped economy. What we're seeing is the K-shaped economy is there are some people that are truly crushed, but in general, it's the renters in general. So you're seeing the people in the top side of the K, they've benefited from the stock market going up, their work from home, and they're benefiting from refinancing. So they're probably the higher you are in the K-shaped economy, you probably have a higher credit score in most cases. So that kind of ties in with what I'm talking about. Yeah.
Right. Yeah. And it surprised the heck out of me because I deal with a bunch of buyers that are 640, 660, 680, and there's plenty of good loan products available for them. The FHA loan for first-time buyers with challenge credit is a good one. But just seeing that 700 and above is, this is over, if we add these three, that's 77% of loans was 700 or higher credit score. And, 54% between these two are 750 or higher, which is, surprising to me.
Crazy,
because I know, there's a wide spectrum of folks who are out there getting loans. And this is 1 in 500 are between 550 and 599. And there's products available for those people. It's like I've said in other videos that I've made, it's probably in these folks' best interest to not lend to them, let them get on some stable footing, because once they get here or here, they're generally increasing their credit score because they're paying off debt and they're doing things that's going to help them long term. And so it's not just that lending guidelines are strict or they're the way they are to discriminate or to only lend to certain people. They're trying to do it in a responsible way. At least that's my belief, because when I talk to folks, like you said, some folks will be much better off. Wait 6 months, wait 12 months, get on stable footing, get a little bit of money in savings, and then buy.
Just a quick question on this chart, because I don't know. Does an 800 credit score get a slightly better rate than 750, or is 750 to 800 kind of the same deal?
Most lenders top bucket a 760 plus.
Okay, so 765, 780, you get the same rate as an 820.
Right, yeah, and you'll get a husband and wife. The husband's got an 812 and the wife's got a 788. And I tell them, it means the same to me. It's all 760 plus. You're getting,
Yeah,
you're
it doesn't
getting
matter. Don't
same
fight over
loan.
12 points.
Yeah, you'll be surprised how many co-borrowers look at that page of the
Yeah.
loan
What the
disclosures and
heck?
go, look, I got an 804 and you only got a 781.
Same to me. There you go. Well, do me a favor, close this window. I want to wrap this up, give you some props.
Okay, how do we end slideshow?
I think that's it. Yeah. Hey, there you go. So
Sweet.
what I want to do here, folks, again, Matt, thank you very much. That was awesome. Again, what we're going to do is look at that monthly, because I think we're going to see a turn shortly. But folks, if you don't know this already, Matt is a sponsor of the channel. He does work for California Mortgages. If you want to refi, owner occupant, give him a call. Matt, how should they reach out to you?
I think the best way is going to be email, Matt, M-A-T-T at mattthemortgageguy.com. Shoot me an email. Let me know how I can help, and it will get to me. I promise. Either somebody on the team will respond and send you a link to the calendar, or I'll respond. And I'm, on and off of calls all day and doing podcast interviews and things like that. So I would hate for a call to get lost in the shuffle.
Sure.
But if you'd like to text me, that's probably a decent way too, to kind of connect. Go ahead and do that at 916-529-7600.
And folks, if you let him know that One Rental at a Time YouTube channel or podcast got you there, he will waive his processing fee, which saves you $6.95. Thank you,
Will
buddy.
do.
Have a wonderful
Yep.
day.